In the cold, unforgiving corridors of the financial world, September 2019 marked a seismic moment, a moment where dreams of grandeur collided with the harsh reality of economics. WeWork, once the darling of the real estate and tech startup scene, faced a brutal reckoning. A multi-billion-dollar valuation, once a testament to innovation and potential, evaporated like morning mist as the company's IPO aspirations crumbled. Investors, analysts, and the public looked on as $47 billion in supposed value vanished overnight, leaving a trail of bewilderment and disbelief in its wake. To understand how such a promising enterprise met its demise, we must rewind the clock to 2010, when an ambitious young entrepreneur named Adam Neumann founded WeWork in the bustling heart of Manhattan. Born in Israel, Neumann moved to the United States with dreams bigger than the skyscrapers that adorned the New York skyline. With a charismatic presence and an uncanny ability to sell a vision, he set out to revolutionize the way people work. WeWork began as a simple concept: shared office spaces designed to foster community and collaboration. At a time when the gig economy was burgeoning and freelancers were seeking flexible workspaces, Neumann tapped into a market ripe for innovation. Alongside his co-founder Miguel McKelvey, he transformed the notion of a traditional office, combining sleek design with amenities that would attract a new generation of workers. The idea took off faster than anyone could have anticipated. By 2014, WeWork was expanding beyond the borders of the United States, opening locations internationally and capturing the imagination of investors worldwide. A year later, Masayoshi Son, the head of Japan's SoftBank, saw something extraordinary in Neumann's vision. In a now legendary 12-minute meeting, Son committed to a $4.4 billion investment, propelling WeWork into the stratosphere of startup unicorns. With SoftBank's backing, WeWork embarked on an unprecedented journey of growth. Offices sprouted in major cities across the globe, each offering a unique blend of work and play. The company wasn't just leasing office space, it was selling a lifestyle, a community. Tenants could work, socialize, and even drink beer from the ubiquitous kegs found in every corner of WeWork's meticulously designed spaces. Saunas and sleek lounges beckoned workers to relax, blurring the line between work and leisure. But behind the scenes, the company's culture was brewing something else entirely. Neumann's leadership style was both magnetic and controversial. He cultivated a cult-like following, with employees buying into his vision with fervent zeal. Stories of extravagant parties, tequila shots at meetings, and lofty proclamations of WeWork's potential to elevate the world's consciousness began to seep.
Public narrative. This was not just any company. This was a movement, and Neumann was its prophet. Yet as WeWork scaled new heights, questions about its financial sustainability began to surface. The company was burning through cash at an alarming rate, leasing upscale office spaces and renovating them into WeWork hubs at a cost few could comprehend. Despite its massive revenue, profits remained elusive, hidden beneath layers of creative accounting. By early 2019, the crescendo of WeWork's meteoric rise reached its peak. The company filed for an initial public offering, touting a staggering $47 billion valuation. Wall Street buzzed with anticipation. Neumann's audacious journey from a single floor in Soho to a global office empire seemed destined for a triumphant climax. Investors were promised not just returns, but a stake in the future of work itself. As WeWork prepared to go public, the world watched with bated breath. For a moment, it appeared that Neumann's vision had been vindicated, that his ambitious bet on the modern workforce was about to pay off spectacularly. The IPO was set to be a defining moment, a validation of the hype and hope that had propelled WeWork to the zenith of corporate ambition. Little did anyone know that beneath this glittering facade lay the seeds of its own undoing, waiting to unravel a narrative of hubris, ambition, and the perils of unchecked growth. As the market soon discovered, the line between visionary idealism and financial imprudence is perilously thin, and WeWork was standing right on its edge. As the world awaited what seemed destined to be a triumphant IPO, the dazzling veneer of WeWork's promise began to crack under scrutiny. The release of the company's IPO prospectus revealed a labyrinth of eccentricities and potential conflicts of interest that left investors reeling. The most striking disclosure was Adam Neumann's sale of the trademark We to his own company for a staggering $5.9 million. This audacious move, nestled among financial disclosures, painted a picture of priorities misaligned with shareholder interests. Moreover, Neumann had secured over $700 million in loans against his WeWork shares, raising alarm bells over his commitment to the company's long-term health. As details emerged, the Securities and Exchange Commission began to cast a wary eye on WeWork's financial practices. Stories of rampant conflicts of interest, excessive spending, and opaque accounting practices began to circulate. The Wall Street Journal launched an investigation, uncovering a corporate culture rife with excess and a leadership style that bordered on the reckless. The narrative of Neumann's erratic behavior and the company's inflated valuation became impossible to ignore. Investors, once eager to buy into the future of work, began to distance themselves. High-profile backers withdrew, unwilling to anchor their fortunes to a ship they now saw as rudderless. WeWork's once lofty $47 billion valuation was now a shadow of its former self, plummeting as skepticism replaced enthusiasm. Amidst the turmoil, SoftBank, the company's largest investor, found itself with no choice but to intervene. Desperate to salvage its investment, SoftBank orchestrated a bailout at a drastically reduced valuation of $8 billion. As part of the deal, Adam Neumann was ousted from his role, yet in a twist of irony that underlined the disparity between executive and employee fortunes, he departed with $1.7 billion severance package. This golden parachute only fueled public outrage, as thousands of WeWork employees faced the grim reality of layoffs without any such safety net. From the ashes of what was once a high-flying startup, WeWork struggled to regain its footing. Restructuring efforts were undertaken, with a focus on recalibrating the company's operations and financial strategy. Yet, despite these efforts, the specter of financial insolvency loomed large. In 2023, WeWork finally succumbed to its accumulated debts, filing for bankruptcy, a bitter end for a company that once envisioned revolutionizing the world of work. The collapse of WeWork left a trail of shattered dreams and financial devastation. Investors saw billions disappear, with little recourse to recover their losses. Employees who had bought into Neumann's vision and dedicated years to the company watched their equity evaporate, many departing with nothing more than the memories of a promised future that never materialized. In the tale of WeWork, the lessons are as stark as they are timeless. Founder worship and the intoxication of inflated valuations can blind even the most astute to the underlying fragility of a business. The allure of a charismatic leader and the promise of extravagant growth can lead industries and individuals alike into precarious territory. As we reflect on this story of rise and fall, we're left with a reminder of the perils of unchecked ambition and the importance of financial prudence. For those who seek to understand the volatile dance between vision and reality, we invite you to delve deeper into the stories behind the biggest collapses in business history. Subscribe to Trend Pulse Daily, where we expose the unseen forces and dramatic narratives that shape the world